Thank you all for being here tonight as my father and I officially release our book together. This book represents the culmination of 12 years of working with my father, which I've loved very much, and the team of highly qualified and seasoned investment professionals here at RVW. The book details principles of optimized portfolio design based on careful observation of what has worked and what hasn't. All of our wealth management team members are uniquely qualified as both CPAs as well as wealth advisors because we know it's not just what you earn, but what you keep that counts. Our portfolios are designed to minimize and defer taxes and to keep costs as low as possible. We were born out of a CPA firm which prepares about 1,500 or 1,600 tax returns annually, which gives us insight into what has worked. The book summarizes what we believe to be the current state-of-the-art approach to investment advising, which is evidence-based and informed by the research of Nobel Prize winning laureates. We think you'll find the book to be an easy and informative read. I'm turning it over to my father, who will go into some of the core principles in more detail. Thank you.
Basically, the book came to be because after being a CPA in Los Angeles for so many decades and realizing the general appalling level of care by the financial community, what we call the charlatans of Wall Street, politely, and in less polite company we call them worse. Now, before 2008, people thought that we were kooks, but in 2008, the extent of their games, their stealing, their self-interest, their conflicts of interest, the small print, the violations of fiduciary duty, etc., all became obvious. And there's probably a dozen movies you could watch that would show you what they did. We were the anti-Wall Street before people realized what we were doing and when they still thought we were crazy. John came on board from BDO in New York when we had about 6 million under management. We now have over $500 million under management. We add a client a week. And that's because our clients, and many of you are here, understand that we do things the right way. And so let me just talk about what we do and what we don't do, because I think what we don't do is as important as what we do. First of all, RVW, we decided when we built RVW it was going to be a very different kind of a firm. And so we looked at things like transparency, full disclosure, no small print, no conflict of interest, fiduciary duty, all the things that you don't get everywhere else at your friendly retail shop. So we decided we were going to build something that was very different. We also decided what we were not going to do, because when you get in the wealth management business, you have to decide which outlet you want to plug yourself into. And there are really two kind of universes. There's what we would call the Wall Street universe. You already know what we think of that. And if you don't, the book will tell you quite well what we think of that. But you just have to watch Jim Cramer and you'll get a sense of what we think of Wall Street. We're the opposite of that. What we don't do anything that isn't liquid, transparent, and where we absolutely will not tolerate any risk as we define it. We have a very different definition of risk, and I will come to that in just a moment. We don't do hedge funds, alternatives, venture capital, angel fund, or what we call flavor of the month investing. We have a saying over here. We say flavor of the month is very good for Baskin and Robbins and not for your portfolio. So if all your friends are doing something, chances are we won't be doing it. That's one of the things we try to avoid, is what everybody else is doing. The masses, them asses. You just move the M. And the crowds are always wrong. In fact, there's a very famous story quoted in the book about Kennedy, the old Kennedy, who sold out before the market collapsed in the 1920s. And they asked him, how did you know to get out? And he said, well, when my shoe shine boy started giving me stock tips, I knew it was time to get out. So let me give you all one tip. When your nail person, your hair person, your Uber driver, or your shoe shine person starts giving you stock tips or asking you for stock tips, please call us. We will regard that as a very big sign of caution. Until then, we see a big green light, which we've seen all the time. One of the things that I will tell you is, I've told you what we don't do, but we really only do two things: secure bonds and diverse equities, and I'll talk to you about each of those in a moment. Secure bonds means we don't buy bond funds, because bond funds, as people will find out when interest rates ultimately move up, ultimately the value of funds and interest rates are inversely related. So everyone looks at their bond funds, and as interest rates have done a once in a multi-generational decline from 18% to 0 more or less, so your bond funds have done really well. Believe me, when interest rates begin to move up slightly, and they will move up slightly, not a lot, your bond funds are going to come down. Also, many of them are not liquid, and they have all kinds of exotica and erotica, things we don't touch. We're into straight, highly rated bonds, not at the unrated and all that kind of stuff. So what we don't do, we do sit on the shoulders of giants, and as I always tell people, you could be a pygmy. If you're sitting on the shoulders of giants, you could see farthest. And so what we did when we got into the business was decide on whose shoulders we would sit. And I'm proud to tell you that we schlepped to Omaha regularly to hear from Warren Buffett and Charlie Munger. We drink the words of Eugene Fama, who won the Nobel Prize, Markowitz, who won the Nobel Prize, John Bogle, who started Vanguard, Booth, who started Dimensional Fund. There are people where we believe the brains reside, and that's the outlet we kind of plug into. So if we sound arrogant, it's not at all that we're arrogant. It's just that we figured out what works and what doesn't, having seen for decades. And by the way, we've seen more portfolios than most other people. Most other people have seen their own portfolios and the lives of their friends. That's what they've seen, right? But you can't bullshit your CPA. We actually see the stuff. So we know what works. And that's how we got into the business, because we kept seeing clients who were disappointed. The presentations were spectacular. And those of you who've been around Century City know that there were years where you could show up at the Regent Beverly Wilshire or the Beverly Hilton Hotel most weeks and have an absolutely dazzling presentation by one of these Wall Street houses. And we kept finding that the results were inversely proportional to the grandeur of the event. I read an article about 14 years ago called The Rip Van Winkle Portfolio. And I was so moved and inspired by that article that we started the company and called it RVW. And the idea was we wanted every client, the promise we make to our clients is peaceful sleep. You can go to sleep, don't worry about a thing. In fact, I was interviewed by the LA Business Journal, and they said, what do you think you do that keeps your clients up at night? And my answer was, if anything we do keeps our clients up at night, we failed in our primary role, which is to give them peaceful sleep. And so that's what we do. We believe that markets ultimately work with short-term aberrations around fair value. So we don't try to outsmart the market. We don't predict, forecast, or anticipate. We listen to the market. We don't tell the market or predict. We believe in diversification as a core, immutable concept. In the book, you'll see John and I call that the only free lunch in investing. And we distinguish between risk and volatility, and that's very important. Risk is you buy a stock and it goes to hell. Any of the tech stocks in 2000, other than about a dozen or two that did well, everything else went, and it won't come back. Time won't help you, prayer won't help you, commitment to the market, nothing will help you. They're gone, they ain't coming back. So we want to eliminate risk, and we want to substitute instead of risk what we call the elimination of risk, which is volatility. That means you own everything you had, it's just that the market periodically overvalues and undervalues what you have. But we really have what we set out to do, which is create a Darwinian system. That's the objective, best of breed. And as soon as something doesn't meet the criteria of the individual funds, it gets kicked out unceremoniously and without meeting the management. We don't have that kind of fundamental research. It's all data-driven. It's all about numbers. RVW is owned, managed, and operated by CPAs who are also wealth managers. We have profound respect for numbers and data and very little respect for gut feel, intuition, predictions, forecasts, and all the other stuff that keep a whole industry going and sucks you of your money. Warren Buffett, in the name of his teacher, Ben Graham, talks about Mr. Market, which says what I'm telling you. By the way, please, everybody, remember to switch on your phones when you leave here. So what do they say about Mr. Market? Here's what they say. Mr. Market is your manic depressive, bipolar, mythical partner who owns the businesses with you. And every morning, Mr. Market comes to tell you what he's willing to pay you for your share of the combined business. The only problem, Mr. Market, he goes through violent mood swings. And he goes through periods where he's up and effusive and optimistic and bullish, and he'll offer you an outrageously high price. Then he goes through a successive period where he's down, forlorn, depressed, and that's called the bear market, and he offers you a pittance. And your job, says Mr. Buffett, in the name of Mr. Munger, in the name of Ben Graham, they all think the same way, and we plugged into that. Your job is to ignore the mood swings of your partner. Because although in the short run, his mood swings determine the value of what you have, in the long run, what you own is determined by the profits earned in the businesses you own. And we think of ourselves as owners of great businesses, selected in a best-of-breed manner. That's what we do. That's why we think of ourselves as eliminating risk and substituting volatility, which means you own everything you had. It's just that the market successfully over and undervalues. And that's a very big part of it. Now, of course, the statistics help us tremendously. most people out there, the Wall Street types generally, although they're catching on to the religion of ETFs, but it's a slow process and many of them are still stuck in yesterday. But look at the percentage of active managers underperforming their own indexes. Take a look. Over 15 years, you've got a 92% chance of underperforming your own index. Here you have a 91%, 93, 89. You've got almost no practical chance of beating the index by going to active management, which means stock picking and market timing. That's why we don't do them. Not only that, but if you did pick the needle in the haystack over here, the 7.8% to actually beat the index, they did it by being active traders. Well, if you're active, by definition, you're buying and selling. And if you're buying and selling, you're paying tax every time. Well, to put it in male terms, if you shave every morning, you won't grow a beard. If every year you're giving a huge chunk of your gains to Uncle Sam, even if you made the gains, what's left is minimal. So your chance of beating, this is what the Wall Street geniuses are trying to convince you they can beat. Good luck. Now, why don't we just go into the S&P 500? People say, well, I like the index, so just buy the S&P 500. I want to show you why. Take a look at every year, 2000, 2001, and so on, and you will see that if you bought just the S&P 500 and you held it for the first 10 years of this millennium, you would have lost 10% of your money over those periods. You would have lost 10%, whereas every other category made money, some of it quite significant, like emerging markets. So you don't want to pick just one index. You have to pick broad indexes, and then you have to overweight, and this is the genius of, well, first of all, we know equity markets have done really, really well. Take a look and note over here, small cap beats large cap, and both of them handily beat bonds. So you see the big picture over here immediately. You want to be in equities, and you want to make sure you have a decent amount allocated to small cap, because one of the overweightings that we know from the academia is that small cap outperforms large cap over time. Not all the time, but over time. And that's critical. So you want to be in smaller cap. Of course, you want to ignore the predictions. This is from the Wall Street Journal this week. Wall Street 2017 market predictions, pathetically wrong. Unbelievable. This is the Wall Street Journal. We didn't make this up. I couldn't be more, I wouldn't even use language quite that strong, but this is the Wall Street Journal. As investors' inboxes once again become clogged with annual outlooks from Wall Street scribblers, there is little admission of the nearly universal failure to predict what happened this year. Unbelievable. And yet these people keep talking, quacking like ducks. Every year they express their opinions, worthless opinions, dead wrong. And next year they're back again on the TV telling you what they think. And it's unbelievable. In any other field, you'd throw them off. Now, one of the things I wanted to show you, which is fascinating, is why are we bullish about the market? I mean, why do we think that there's no reason to bail out? We are in a period of very low interest rates. And unlike most people who think interest rates are about to go up next week or next month, they'll go up, but a smidgen, not much. Now, why does everybody think that they won't go up? Well, first of all, once again, we don't need opinions. We can read the data. I can tell you from this chart that the inflation expectation of the market is very low. How do we do that? We have two kinds of treasury bills. We have a 10-year treasury that pays interest, and we have a TIPS, right? That's the inflation-protected security. Identical security, comparing apples with apples, right? You've got two 10-year securities, both issued by the United States government, both 10 years. One is paying 2.38%, and one is paying 0.5% plus inflation. So if you take this from that, you know what the market's telling you inflation will be. You don't have to be a genius, just read the data. So if I'm telling you as a fact that the market's telling us that inflation will be about 1.8%, then you know that fundamentally interest rates are not going to go up. Because if you go back to Economics 101, interest rates are the sum of two things. Inflationary expectations, which we now know what it is. Not we predict, we know, we read the tea leaves. We know what inflationary expectations is, and there's a reward for deferring consumption. That's the classic definition of interest rates. Well, we know that if this is going to stay like that, by the way, it's been remarkably constant, that gap. Even when this one goes up, that one goes up. So this gap has been remarkably constant at a very measurable number of about 1.6, 1.7, 1.8%. Once we know inflation's low, interest rates will be low. And if interest rates are low, then we get to the position where equities are fundamentally adjusting to two mega trends. Number one, the revival of the US economy. And it's all over the place. People are not realizing it. They're not reading it. It's all over the place. The economy is in a revival, a massive, wide revival, largely made possible by the technology revolution. What we are seeing is the incorporation of technology. And if you want a, for instance, or a relative comparison, think back to electricity and how it impacted every aspect of the economy 100 years ago. We are in the next big revolution since electricity. Every single industry, whatever you guys do, wherever you deal, anything you meet, anything you touch, any business you're in, everything has been transformed by technology, and it's coming into everything you do. So costs have plunged and profits have gone up. There are terrible side effects in the economy in terms of employment and societal issues and the gap. I'm not here to deal with that. We're dealing with economics and investing for today. You want a political or sociological lecture? Another time, another place. But for right now, low inflation, low interest rates, economic revolution powered by technology, and an adjustment of assets to reflect fundamentally lower interest rates. Obviously, interest rates at which you capitalize an asset are inversely proportional to the value of the asset. The lower your interest rate, the higher the value. If you need an explanation, come see me afterwards or talk to any of the RVW people. It's mathematical. Interest rates go down, the value of assets goes up, the value of future income stream goes up, the present value of dividend flows goes up. So we're seeing the market reflecting two things: the absorption of technology, which is transforming every aspect of industry, and lower interest rates, which mean all assets are more valuable. Those are key issues. So are we worried about the market? No. Does that mean the market will go up tomorrow? Absolutely not. It'll be a bumpy, turbulent ride up. Best way to think about the market ahead is imagine a man walking up the stairs or a woman with a yo-yo in his or her hand, and your job is to watch the feet and not the yo-yo. That is the image. So the market will go up and down. That's the yo-yo. The feet will keep moving up. That's the key. We've said it for 10 years, 12 years, and we're still saying it. I was on a trip about a year ago. People on the boat were saying, market's going to collapse, market's going to collapse. You may remember it. And I said, the market's undervalued. Stay buckled in. The ride will be very bumpy. Assured arrival at a glorious destination. Very bumpy ride. And of course, that's what happened. And we don't see any end in sight at this point, barring, of course, a black swan. But that would not derail. It would simply defer. And what we'd have is just the yo-yo would just come down again. But the fundamentals are incredibly strong, not only in the United States, but around the world. What we have for the first time in decades is a globally synchronized growth pattern. That's almost unprecedented. Usually we've had one segment or one industry or one country or one region. Right now we have almost every country in the world, or certainly all the big ones, the OECD, all of Europe, etc., all of Asia, almost everything, almost in a magical way, is synchronized for simultaneous growth to a larger or lesser degree. So that is quite extraordinary. In fact, I just wrote an article for the Jerusalem Post, which will appear in their year-end issue, and that's what I said. Globally synchronized growth for the first time means equities around the world are doing well and undervalued. I don't want to get into a whole conversation about factors, but if you want to go into the Eugene Fama thesis of really the essence of what he came up with in what we call the science of capital markets, the graph really shows you that what you want to pick is not stocks. What you want to pick is factors. Because we know over time certain factors have out-delivered others. Not stocks, but groups of companies that represent a common factor do very well. So for example, we know, and I've already told you, smaller companies do better than large ones over time. Value companies do better than growth companies over time. Stocks that engage in aggressive buybacks do better than companies that don't over time. Companies that pay growing dividends supported by growing earnings do better over time. So what we do is focus on what are the factors we want to access and what's the most cost-efficient and tax-efficient manner to access the factors that have historically outperformed. That is the essence of the secret of RVW in a low-cost and tax-efficient way. That's that, and I'm not going to get into this in great detail, but if you take a look over here, and it's a bit too small for you to see the details, that's really what we're showing here, is combining all of these factors, and this shows you that they all over and underperform over time. But if you blend together the factors that have historically outperformed, and you look at the period from 2002 to 2016, combining these factors will give you the largest return by a significant amount over any individual factor or any other method of stock selection. Whole other conversation. I really don't want to get into that right now. The statistics or the chance of beating other investors in active management is so small, it's not even funny. Just another statistic showing really the same thing as I showed you earlier. Your chance through active management is so small, it's not even funny. What's the big problem? Thaler just won the Nobel Prize for it. It's called behavioral economics. The biggest enemy all of us have is our own instincts. If we follow our instincts, we're almost certain to do wrong. Our instincts will guide us to buy at the top and sell at the bottom. I come from Africa. If you go on safari, you will watch animals migrating. And you will see, when you watch a migration of animals, the animals basically herd when they sense comfort and security, and they flee when they sense danger. That's just the way it works in the wild. If you don't, just look at a National Geographic TV show, and you'll see animals that feel comfortable herd, animals that sense danger flee. That means that we are genetically programmed the same way. We will hang out with everybody else when we're feeling comfortable, and we'll flee at the bottom. That's why everybody sold in 2008, and many of them are still waiting for it to come back, because the biggest challenge all of us have is to suppress instinct and follow science. It's a big challenge. Nobel Prize winning for basically saying that in a little more sophisticated way. So here are some of the terrible news items that came up in the period from 1970 to 2016. Every one of these vertical lines at the time was a catastrophic, cataclysmic announcement. Every one. And yet if you sat and held on from 1970 to 2016, $1 accumulated to 48 by ignoring the news, which is mostly noise from the standpoint of investors. It's a stunning statistic. If you want afterwards, I'll even forward this if anybody wants it, but take a look at how much bad news there was. You can imagine from 1970 to 2016, virtually every year there was another piece of terrible bad news at the time. By the way, Business Week's cover in the early 80s was the death of equities, just so you know. Do you know, that's the famous one. If you do go Google and put their Business Week, the death of equities, there's a whole theory which says magazine covers are a contraindicator. When they tell you to get out, get in. When they tell you to get in, get out. So, but the death of equities is probably the most famous one, but there are many of them, and I'll show you a couple more just to show you what you need to do with the news headlines. So this is what most people do. They follow their emotions, right? Optimism, elation, that's when the peak buying takes place, by the way. Then they go through nervousness and fear. That's where the peak selling takes place. And of course, the dotted line is the RVW mindset, which Charlie Munger calls equanimity. It's a fantastic word. It's a great way to train yourself. Just feel nothing. In fact, our clients call us and they're very happy. We tell them, please don't get happy. Happiness is a very dangerous feeling in equity investing because you're likely to invest more when you're feeling happy. Don't. And of course, feeling sad, thank God we don't have too many of those people. But we don't want feelings involved. It's all science. It's what's the financial plan, where do you want to end up, and back into the portfolio that will result in the outcome you want. It's not about what the news says today or tomorrow or your feelings of happiness or sadness. That's out. It's all about what's the financial plan, what are the goals, and let's back into a program that'll get you there. That's what it's about. Feelings are very dangerous things in this business, and you see it over there. Here's the problem, the risk of reacting to your instincts. If you invested from 1970 to 2015 in the S&P 500 and left it, $1,000 grew to $89,000. If you missed the best one day out of 45 years, one day, you went down from 89 to 80. If you missed 5 days, the best trading days, you went from 89 to 58,000. If you missed the best 15 trading days, you went from 89 to 33. And if you missed the best 25 trading days out of 45 years, you went from 89 to 21. So you see the dramatic problem because the market does not go up in a straight line. It goes up in spurts. And if you're not there for the spurt, you'll never make it up. That's the risk of market timing, one of the risks. So here's some more headlines. This is the death of equities. August 79. If you'd bought this day, you were at the beginning of one of the great bull markets of the history of the American economy. Newsweek, the big bad bear. Where do they point it out to you? Right here. Look what happened virtually the next week. I mean, I couldn't make this stuff up. It's just incredible. Your job, therefore, is to ignore this stuff. God created a delete button for a reason. Brazil takes off. This is another incredible one. Now, Brazil, of course, did take off. It just didn't take off vertically. It took off horizontally. The giant country was a huge explosion weeks after this. And this is The Economist. This is not one of these doom and gloom magazines you get all the time. This is The Economist. And of course, Money Magazine, the hottest market. Look where they told you to buy, the hottest market ever. Unbelievable. I mean, you could not make this stuff up, but I'm doing this just so you believe me. So how is our wealth system different from others? We set the sails, right? We do not control the wind. We don't control the wind. We don't even predict the wind. We never know when it's coming. So what do? We set the sails, which means size, value, profitability, momentum, dividends, and buybacks. Those are the aspects we want to focus on in our portfolio. We keep headwinds to a minimum, which are taxes, which we virtually eliminate, trading costs and management fees. We let the wind do its job. Get out the way and let the wind do its job, and then we adjust the sails when needed. If you want to know the RVW method, that's the method in 4 points. We're fiduciaries. That's very important. Very few people are fiduciaries. Where's John? John, tell us about your exam you just took. John is a certified personal fiduciary. Tell us about that.
As fee-only RIAs, we are uniquely fiduciaries. I say uniquely because very, very few advisors and advisory firms in the marketplace today are pure fiduciaries. Most of them are not fiduciaries at all, or what's called a dual registered advisor, which means sometimes they're acting as a fiduciary and sometimes they're not. And it's very difficult from a consumer's perspective to determine whether the advice they're giving you in a given moment is in the capacity of a fiduciary or not. And I'm proud to tell you here at RVW, when we do portfolio construction and design, we are purely fiduciaries. Nothing we sell or recommend or advise gives us any sort of kickback or commission or override. And the mutual funds and ETFs we select, or the bonds we recommend, are only recommended because they are the best for our clients and for no other reason. We put our clients' interests ahead of our own in everything we do. It's so interesting to me that a financial advisor doesn't have to be a fiduciary to their clients. It would be like going to a doctor and finding out his primary objective was not to get you better. But here at RVW, I'm proud to say it's one of the many attributes which differentiates us from the rest of the financial planning community.
John is personally certified as a fiduciary, but our firm is a fiduciary firm. We place our clients' interests ahead of our own. We pay for our own cruises, our own health insurance. Yeah, we pay for our own cruises, our own health insurance, our own rent, our own pension plans. No, there's no kickbacks and side deals and vigorish going on. Now, just to give you a sense, to prove what I told you earlier, and just a little bit of science, I could spend hours on this stuff, but there's a book that we did spend hours on. You'll be able to pick all this up. But if you take a look, I told you before, small cap outperforms large cap. These are rolling 10 years going back to 1937. The blue lines are the 10-year rollings where small cap outperformed large cap, and the red line are where large cap outperformed small. So you know that over time, blue outperforms red, small cap outperforms large cap. Not all the time, over time. Remember that. Here's another one. I told you that value outperforms growth over time. Blue line, value outperforms growth. Red line, growth outperforms value. Take a look. You could hit a patch where growth outperforms, but if you wait long enough, this long pattern has always recurred. So that's what I wanted to tell you. I wanted you to know roughly what we do, how we do it, why we do it. Thank you so much.